This is the April market review 2024. So I just want to quickly go over it. Obviously, a bit has changed, as you can see, as of speaking on the 15th of May 2024. Just want to go over this so it summarizes it in kind of bite size in a verbal content. So what did we see in April? We saw the Fed less likely to cut. 6 times. It was always ludicrous at the start of the year to maybe 1 to 2 times. Some people have said there's going to be no rate cuts. Some people have even put in probably not the base case in a lot of asset managers, but they have put it as a scenario where the Fed could increase rates, although CPI data looking to come out is looking to actually have some kind of effect of those raising interest rates that have been somewhat lagging over the last kind of year, actually taking effect on the US consumer that's been quite resilient so far, data dependent. So Jay Powell is always going to be data dependent. I think they've made that very clear. So it will always be a give and see, but I think it's most likely that you may get 1 or 2. I think from many asset managers, rate cuts in 2024. So where does that leave the S&P 500? So it's, as of speaking, as of the 15th, it's hit new highs again. It's kind of a tale of 2023 where it ended. It's been lifted up by a few names, although I think this year it could have more influence, especially towards the end, by the everything else rally. So we saw the Magnificent Seven rally in 2023 kind of lifted the S&P to highs and continuing into 2024. Now, you could see everything else. There's a big kind of discrepancy between some of the oil stocks, for example, some of the banks, some of the healthcare that you see in the US. So we think that the US could have growth in kind of the quality stocks outside of the bigger tech names. So that's where we're looking to invest for the end of the year. As you can see from the graph there, it kind of illustrates the discrepancy between the Magnificent Seven and the S&P 500 earnings. So going on to the Eurozone, now this is a bit more clearer, both in the Eurozone and the UK, on where to cut rates. It's looking sooner than the Fed. UK may be the first one, having quite weak data. So Andrew Bailey may be cutting rates sooner rather than later, potentially in the summer. ECB may not be far behind. In terms of euro equities, again, kind of mimicking much to do with the US, but without the tech story, they are going to highs. What we've seen interestingly in kind of April and throughout May so far is actually the UK market, well, FTSE 100 that's more globally orientated, is that we've seen it actually get some growth. Now, it's still trading at quite a low PE ratio. If you compare it to the US, and it's at a kind of 11-12 PE ratio, that's half of what the US, or even less than half of what the S&P 500, justifiably so in most cases, as it does lack the innovation and the tech companies as what we've seen in kind of Arm, a UK founded company that's gone and listed on the NASDAQ in the US. So we're seeing kind of a bit of a resurgence in that, and people potentially looking for value have been kind of investing into the FTSE 100, into their companies. They're quite stable companies, the banks, insurers, oil stocks, healthcare. Not exciting, but if they're trading at kind of 10 multiple, half of what the US investors are kind of waking up and seeing that there may be potential in this. And you have seen quite a significant increase in the S&P 500. As you can see year to date there, and it's actually increased over the last few weeks. So going on to China rebound, as I said in kind of January time, I've been saying throughout the year, is that when investors do see a sentiment change in China, you will see kind of the market turn out. Obviously, CCP have done a number of policies, both monetary and fiscal, to try and implement kind of sentiment in the markets. That just in last night, actually, yesterday, put long dated bonds again, another kind of sign that just kind of stimulate growth. Or however, the sluggish sentiment was mainly due to the property market, and this is kind of changing somewhat, and you're seeing the kind of data coming out of China, although it may not be 100% reliable, as China never is. It's coming out positive. Now, what you've seen in the Hang Seng is it's growing over kind of 7%. It's down, it's up from around 16% from its January lows. And it still has quite a way to go. If you look particularly at the tech names within the China Hang Seng market, so for the likes of Alibaba, Tencent are actually trading at quite a low multiple compared to the US counterparts. So it's just one to keep an eye on. And we've gone into detail into about some of the implementations that China economies and CCP have implemented and some of the growth in the coming years. Now, Japan, the yen, again, a story. US yen hit near 160. You did see the BOJ have some intervention come in, even though it was a holiday. This kind of seems to be the cutting price. The yen seems to be incredibly weak. Whether you'd go long yen, probably long yen dollar. But again, what will the BOJ have to do to kind of control its inflation? Will it have to rise interest rates again? It's kind of a sticky situation. In terms of the Nikkei, I do think it's getting a little pricey. I do think it's a good market. I do think there's still some growth in it, and I do think it will mimic what the US. But for a market that's trading now on a 17% multiple, it's near actually what the US is, that lacks the innovation that the US does. It's getting near its peak in terms of where its growth. You've seen significant growth throughout the year, as you can see on that chart, over 16% and growing. Don't think it would have that again. Obviously, I could be wrong, and listen to specifically what I'm saying about investing in general. So what would I do right now in terms of, we've stated what Warren Buffett is doing. He's got 189.99 billion in cash. Your T-bills, for the most part, it's yielding as of 5th of May and around about now, it's talking on the 15th, still 4.8%. It's still a good yield. So to coin the phrase bill and chill, I still think is a good strategy for a lot of investors that don't want to take that risk, that see the equity markets as quite high now, right now, and don't really want to dip their toes in. They just want to get that yield, collect the coupons, not have to think. I do think that is still a strategy for a lot of people. And I don't think it will last there for much longer. To where to go into the curve, I'd look more towards right at the belly of the curve and kind of lock in those yields. In terms of the equity markets, I think I stated here just something very simple, like the equal weighted. I'd also kind of put reference to something like that, the US high dividend, Vanguard high dividend yield, kind of more quality companies, and also the Asia Pacific developed ex-Japan, some more Australia. Do you think Australia's got a bit high recently? I've kind of spoken about that at the start of the year. I thought it was good value. The ASX 200 at 7.2. Now it's kind of at 7.7. I think it's, especially with the gold prices where they are in China's economy, still not fully functioning. I do think it's quite high, but it's a good market nonetheless. And I do think that there's growth. Singapore, obviously, talked about this numerous times on the blogs. Great index to be in. Quite bullish about that, especially Singapore banks, and Hong Kong. We spoke about that. So something like the iShares Asia Pacific ex Japan. That's why I'd particularly look in the equity markets for some kind of diversification outside the US. Again, just from a legal perspective, this is not financial advice. Anything you do take is at your own risk. But hope you found this useful, and we'll do a review next month.